Just gonna check my balance here. Oh my gosh. The crypto markets are getting clobbered. So let's talk about it. We're now officially in bear market territory with Bitcoin down 10% in the last 5 days. Ethereum down over 10% in the last 5 days, at least at the time of recording of this video. And most of it at the time of this recording has taken place in the last 24 hours. So what does this mean? What do you do? One thing you could do to make the metrics of at least one thing go up instead of down is like this video, give it a thumbs up, and comment. Crypto might be dropping, but you can always give this video a boost. But yeah, what do you do when prices are in a free fall like they have been? Unfortunately, the short answer is it's anybody's guess. No one has any idea what's going to happen next. But here are a few things that can put what's going on into context and maybe help you breathe a little bit easier, even if things continue to go downhill for the near term, because there are two major factors that suggest that might be the case. But long term, if you're a believer in crypto, if you're a believer in this space, this is actually a really positive thing. Let me explain. So let's start with the bad news. There are two major threats to price action in the crypto markets over the coming weeks and months. Number one is the Federal Reserve raising interest rates, and number two is leverage within the market. As many of you may know, some of you don't know, recently the Fed announced that they're going to be raising rates, and they're going to be raising rates much faster and more aggressively than a lot of market participants originally thought. So what does the Fed and interest rates have to do with cryptocurrency in the first place? We're over 13 years into this period of low interest rates that have been kept low by the Federal Reserve in a response to the 2008 market and housing crisis, the financial collapse that was heard and felt around the world. There's actually a video that I'm linking to explaining this whole thing more in depth if you're interested. But long story made short, for the sake of this video, focused on crypto and what's happening with current price action, is in order to save the market, the Fed stepped in and lowered interest rates. And the way the Federal Reserve does that is by buying mortgage-backed securities and bonds. Because as the value and price of bonds goes up, interest rates goes down. There's an inverse correlation between the two. So in order to keep rates low, to make it easier for people to get back into housing where mortgage rates are low, it means that people theoretically have an easier time purchasing housing because money's cheap to buy. The Fed lowered rates by buying bonds and mortgage-backed securities, and they've been doing it for over a decade. Now, the thing about the Fed buying all these financial assets to keep interest rates low and inflate the price of bonds and keep those stable is they do it with printed money. It remains to be seen whether or not the Fed is going to stick to their guns and continue to raise rates and reduce their bond buying program, or if they're going to back off again. So that's factor number one in dropping crypto prices. Factor number two is leverage, and this is actually, in my opinion, much more serious than the Fed raising rates. See, there are more than one ways to be exposed to crypto. The smart way is to buy an assortment of non-speculative stable coins like Bitcoin, Ethereum, XRP, Cardano, whatever it is that fits your narrative and your viewpoint of the world, and you just hold on to it. If the market goes up 1% and you've invested $100, you've made $100. If the market goes down 1% and you've invested that same $100, well, you lose $1. Really simple math, really easy to understand. And if prices drop, it's not a big deal, because if you really believe in DeFi and decentralization of everything, you're just going to buy more as prices drop. You're in it for the long haul. But traders are also trying to take advantage of this market, or at least they're trying to. You see, when most people think of trading, they understand that players are buying and selling securities to try to make money as those prices go up and as they come down. They're not necessarily buying and holding, they're actively participating in the market for short-term gains. But 90% of traders end up losing money over the long run, and the reason boils down to leverage. And leverage can burn other participants in the market that aren't trading on it. So here's how leverage works. Say you have $100 that you want to trade. We're going to use $100 to keep the numbers simple. If I'm an investor, like we said, I can buy $100 worth of Bitcoin. The market goes up 1%, I've made $1. The market drops 1%, I've lost $1. But in trading, traders borrow money in the form of margin. This allows a trader to control much more of the underlying asset than the cash that they actually hold in their trading account. And in the crypto space, the leverage is insane. We're talking 1 to 10, 1 to 100, 1 to 1,000. So what does this mean? It means that there are traders out there, again, to keep numbers simple, that have $100 in their trading account. But that $100 is trading 1,000 times that amount of the underlying asset. So we'll use Bitcoin, for example. A hypothetical trader might have $100 in his or her trading account, but that $100 is controlling $100,000 worth of the underlying asset. Meaning, I have this much in my account, but I can buy or sell this much of Bitcoin, Ethereum, whatever. So what this means is if I'm a trader and I buy Bitcoin and I go all in with all of this leverage that's available to me, and the price of Bitcoin goes up 1%, I'm not earning 1% on my $100 balance. I'm earning 1% on the $100,000 of the underlying asset that I'm trading, which is $1,000. So my account value goes from $100 to $1,100 on a 1% move in my direction. Pretty dope, right? I mean, I guess if the market moves in the direction that you think it's going to. But when the market moves against traders that are leveraged to this extent, you can see that it doesn't take much for a move in the underlying asset where you're controlling $100,000 of that asset. If the market moves against you, your actual account value can get ripped up and destroyed pretty quickly. In fact, it doesn't take much for this to equal a negative balance in your account. And that happens. So to protect themselves from traders that use their exchanges and brokerages have a mechanism in place to protect not only the trader that's using their platform, but themselves from having a negative balance that has to be paid back. And those mechanisms are margin calls and forced liquidation. If I'm a trader that's using $100 at 1,000 times leverage and the market moves against me, even if it's just a fraction of a percent, that could leave me with an $80 loss with only $20 left in my account until it hits zero. If my brokerage or exchange sees that, they'll give me what's called a margin call, which is an alert saying, hey, look, you're getting pretty dangerous in terms of your ratio of cash that you have in your account versus the risk that you're holding on your position. You need to put more money in there to change that risk to value relationship, or we're going to liquidate your account for you. If I can't come up with the money to meet the margin call, the exchange or brokerage will close my position for me so that I don't go to zero or into the negatives. And it makes sense because if they don't do that, I could go into the negative. And if I don't have the money to make that negative balance good, they're the ones on the hook for the negative balance. So if the market drops fast enough and I'm trading on leverage and my account value drops below a certain point, the exchanges or brokerages will bypass the margin call and go straight to liquidation to protect me and protect them from owing money that I may or may not have. Because remember, if my account value is just $100, but I'm controlling $100,000 of an underlying asset, if that underlying asset drops by 1% and I don't close my position, I've now lost the principal in my account plus the remaining 1% multiplied by the 1,000 times leverage that I'm using, which means I'm in the hole $800. But we're just using small numbers here for the sake of explaining this. There are traders out there that, there's a lot of them that are trading $100 accounts, but there's a lot that are trading $1,000 accounts worth tens of thousands, hundreds of thousands, and even millions of dollars. Traders trading on leverage, using leverage on a base amount of money that's massive when you pool it all together. So in an environment like this where prices are already dropping substantially because people are fleeing the market because they no longer want to hold a risk-based asset because the Fed is raising rates, if you've got all these traders that are trading on leverage, getting margin calls that they can't meet, they're forced to sell. And the traders that don't sell, once their account hits a certain risk to holdings ratio, exchanges will liquidate their position for them, causing even more forced selling and lower prices in the near term. It's just adding more cuts to an already bleeding market. So the Fed raising rates is significant, but it's over-leveraged traders that really poses the biggest risk to this market in the short term because they are the ones that could cause a massive flash crash. There are a lot of voices in this space saying that, we're never going to have another 90% drop. Crypto is big enough, it's widely adopted enough, even though it's still early, it's widely adopted enough that we're never going to see the crazy cycles that we experienced in the past. But the trading and the margin levels that people are taking on, it's kind of the black swan that could throw a wrench into that theory. And we could easily see a 90% drop depending on what happens with these traders and the margin levels that they're trading on and whether or not they get margin called, whether or not they'll be able to meet those margin calls. And it also depends on how many accounts are forced liquidated by exchanges that they're trading on. Because recently numbers suggest that leverage within the crypto markets is at an all-time high, which means an all-time high risk of everything I've been explaining about leverage and trading. It's an all-time high risk level for all of that to happen. So yeah, things could get much, much worse in the short term, especially if you're a trader who's over leveraged and overly bullish, because now you're trapped. But if you're a long-term investor, we're possibly on the brink of one of the biggest buying opportunities and opportunities to make real wealth in recent history. Because despite all the hype, the crypto space is still really small. Currently, the total market cap of the entire crypto market is right around $2 trillion. That might sound like a lot, but if you consider the fact that Apple, a company by itself, is hovering around $3 trillion in market cap, and cryptocurrency has the potential to replace not only the internet as we know it, but banking as we know it. The DeFi side of crypto is a monstrous market that I think it's only a matter of time. If you believe in DeFi, if you truly believe in crypto, you know that that's where things are heading, unless something goes really, really wrong. And the entire banking space is going to dwarf the market cap of Apple. And so even where things sit right now with crypto, we're just at the beginning. Now, I'm not here to give you advice. I'm not here to tell you to buy or to sell or that things are going to get better or things are going to get worse, because at the end of the day, nobody knows. But given these two major factors, leverage and the Fed increasing rates, the short term in this market could produce a lot more blood. But long term, we're likely to view this period as just a pebble in the road to a brand new world, especially on the DeFi side of space, because the Fed has been printing money for over a decade. The US government has been spending money like it's their only pleasure in life for over 60 years. It's led to inflation and the erosion of purchasing power of what you can do with a dollar. And it's not just here in the US. Governments around the globe they're all perpetuating this type of activity. It's these same governments around the world who have cited crypto as a financial loophole for criminals, who are actually the ones perpetuating criminal activity, stealing wealth from their populations in the form of inflation as they borrow money to fuel reckless spending that benefits their few friends in power and screws the rest of us. And the days of humanity as a whole accepting this type of destructive behavior from governments are on their way out. The blockchain space has already started to revolutionize the way that we view money, value, banking, what is safe, what can be trusted, and what can't be. And for a market cap of just $2 trillion in the crypto space, it's easy to see that we're just getting started. Tell me what you think about all this. Like and subscribe for more. You can follow me on Instagram or on TikTok, where I'm most active. It's not all finance stuff. I post kind of whatever I want over there. So if you want to get to know me, hit me up over there, and I'll see you next time. Bye.